In Vegas, the house always wins, until regulators move the goalposts. Caesars faced nearly $10 million in penalties for letting high rollers sidestep anti-money laundering checks. Resorts World is now the latest target of federal and state scrutiny. Behind these headline-grabbing cases, there is a growing wave of investigations, fines, and lawsuits reshaping how Las Vegas casinos operate. Why are the stakes and the risks getting higher by the week, and what is really driving this crackdown? Nevada's gaming industry operates under a regulatory structure that is both layered and formidable. At the state level, the Nevada Gaming Control Board, NGCB, acts as the investigative and enforcement engine. Its agents conduct background checks, audit casino records, and run undercover operations. When violations surface, whether it is a suspicious pattern of cash transactions or a breakdown in internal controls, the NGCB has the authority to file formal complaints against any licensee. These complaints can trigger a range of consequences, from negotiated settlements to demands for sweeping changes in a casino's compliance program. In more severe cases, the NGCB recommends disciplinary action, including hefty fines, new license conditions, or even outright license revocation. Oversight does not stop there. The Nevada Gaming Commission, NGC, sits above the NGCB as a quasi-judicial body. The commission is responsible for issuing, suspending, or revoking gaming licenses. When the NGCB brings a case, the NGC holds public hearings and reviews evidence, often revealing the inner workings of casino operations and the rationale behind regulatory concerns. These hearings are no longer backroom negotiations. They are on the record, with transcripts and settlement documents that lay out exactly where a casino's compliance program fell short. Federal agencies add another layer. The Financial Crimes Enforcement Network, FinCEN, treats casinos as financial institutions under the Bank Secrecy Act. That means every casino with more than $1 million in annual gaming revenue must file currency transaction reports for any cash movement of 10,000 years or more in a single day. Suspicious activity reports are required whenever staff suspect money laundering, structuring, or other financial crimes. FinCEN's toolkit includes civil penalties, consent orders, and in the most serious cases, referrals to the Department of Justice for criminal prosecution. Consent orders often require casinos to overhaul their monitoring systems, retrain staff, and submit to independent audits. The Department of Justice steps in when willful violations cross into criminal territory. Department of Justice prosecutors have secured plea agreements and deferred prosecution deals against casinos and executives who facilitated money laundering or failed to act on known risks. These federal actions can lead to multi-million-dollar settlements, forfeiture of assets, and in rare cases, criminal convictions. Each of these agencies operates with distinct powers, but their actions are increasingly public and coordinated. NGCB complaints and NGC hearings bring state-level failings into the spotlight. FinCEN press releases detail the mechanics of consent orders and the reasons behind civil penalties. Department of Justice filings lay out the evidence for criminal referrals, sometimes referencing the same patterns of suspicious activity flagged by state regulators. This multi-agency oversight means that a compliance breakdown in a private gaming salon can quickly escalate from an internal audit finding to a public hearing, a federal consent order, and, if ignored, a criminal case. The result is a system where regulatory levers, license conditions, civil penalties, and criminal referrals are not just theoretical. They are tools in active use, reshaping how every major casino on the Strip manages risk and conducts business. Federal law draws a hard line in Las Vegas casinos. Any cash coming in or going out that totals $10,000 or more in a single day triggers a currency transaction report. Compliance is not just paperwork. Cashiers, pit bosses, and hosts are trained to spot large transactions, whether it is a stack of chips at the cage or a discreet handoff in a private room. The system is designed to capture the real flow of money, even when patrons try to break up deposits. A tactic called structuring, which is itself a red flag. But the rules go further. When staff suspect something is off, such as a player cashing out with little play, odd increments of cash, or a story that does not add up, they must file a suspicious activity report. Unlike a currency transaction report, which is triggered by a number, a suspicious activity report relies on judgment. It asks frontline employees and hosts to share what they know, even if that means flagging a high-value guest. Regulators drill down on 6 controls in every casino's anti-money laundering program. First, identification and verification, confirming the identity of anyone moving large sums across all departments. Second, daily aggregation, tracking all cash transactions by patron, no matter where they occur. Third, source of funds checks, especially for high rollers. The casino must document where the money comes from, whether it is a domestic account or an overseas transfer. Fourth, monitoring for suspicious patterns, chip walking, rapid buy-ins and cash-outs, or third parties fronting money. Fifth, robust, suspicious activity report and currency transaction report filing systems that integrate across tables, slots, and hotel operations. Sixth, ongoing staff training and independent testing, so regulators see that employees know the rules and that systems work under pressure. Private gaming salons and high-limit rooms get special attention. These are the domains of international high-value players, sometimes called whales, who play for stakes that dwarf the main floor. In the Caesars Palace case, compliance staff were isolated from hosts and marketing teams managing these patrons. The result was millions of dollars in unverified funds moved through private rooms, with little oversight and almost no source of funds documentation. FinCEN flagged this directly, warning that siloed compliance is not just a casino risk, it is a threat to the financial system. Today, hosts and marketing executives are expected to share what they know about a player's background, business ties, and spending habits. Regulators want this intelligence to flow directly into risk assessment and reporting. When hosts keep information to themselves or compliance teams lack the authority to act, the system breaks down. Recent enforcement actions show that even a single missed suspicious activity report or a poorly documented source of funds check can trigger millions of dollars in penalties, forced audits, and public hearings. Casinos now balance hospitality with vigilance. Every private jet, every line of credit, every comped suite is reviewed. When systems work, suspicious patterns are flagged early. When they fail, the consequences are public and severe. Anti-money laundering compliance is no longer a back-office task. It is woven into the daily reality of casino operations. Inside the walls of a Las Vegas casino, the tension between revenue and risk plays out in ways that rarely make headlines. In high-limit rooms, hosts and marketing teams are tasked with keeping the city's most valuable players happy, sometimes at the expense of asking hard questions about where the money comes from. Compliance departments, responsible for anti-money laundering oversight, often operate with lean teams compared to the scale of coke moving across the floor. At one major strip operator, regulatory filings show that after a multi-million-dollar penalty, the company spent just over $1 million to increase compliance staffing. That increase was dwarfed by the billions in annual gaming revenue, highlighting the gap between enforcement costs and operating income. In practice, compliance can remain underfunded even after high-profile penalties. Pressure to prioritize VIP revenue intensifies during economic slowdowns, when mass-market tourism lags and operators chase a shrinking pool of high-value guests. The Nevada Gaming Control Board's complaint against Resorts World Las Vegas revealed that a handful of high-risk patrons, including convicted illegal bookmakers, lost millions in a matter of months while enjoying lavish perks, private jet flights, comped suites, and gifts. Despite written notes flagging certain guests as known bookmakers, the casino's anti-money laundering, often called AML, committee failed to intervene for months. Internal records described one patron as running a book and soliciting clients on property, yet hosts continued to extend credit and amenities, while compliance staff lacked the authority or resources to override the drive for revenue. Underfunding is not just about headcount. Outdated surveillance and reporting systems have been cited in several enforcement actions. At some properties, player tracking and AML software remains siloed, making it difficult to spot structuring or suspicious betting patterns that cross between tables, slots, and hotel operations. Independent testing and validation of monitoring programs and expectation in financial institutions has lagged behind at even the newest mega resorts. In hearings, regulators have questioned whether technology budgets are directed more toward guest experience than toward compliance upgrades. Ownership structures add another layer of complexity. Many strip resorts are now owned by real estate investment trusts, REITs, and leased back to the operators. While the gaming license remains with the operator, REIT landlords can influence capital spending priorities. Board minutes and analyst calls reveal negotiations over rent, capital expenditures, and acceptable returns, with compliance sometimes caught in the middle. Governance experts warn that split ownership can blur accountability, making it harder to pinpoint who is responsible and who will pay when remediation is needed. Even with written policies and committees in place, cultural factors shape outcomes. Former anti-money laundering officers and regulators describe a persistent internal message: do not chase away profitable customers. In several recent cases, compliance staff raised red flags about high roller activity, only to see their concerns discounted or ignored by executives focused on quarterly results. The result is a system where operational fragility is built in, where the drive for VIP revenue, under-resourced compliance teams, outdated monitoring, complex ownership, and internal pressure not to slow down play all intersect, creating vulnerabilities that regulators are now bringing into the open. Las Vegas casinos are navigating a landscape shaped by forces far beyond the gaming floor. In 2021, Nevada welcomed just under 32 million visitors, down nearly 25% from pre-pandemic highs. As mass tourism lagged, operators leaned harder on high-value guests, with some resorts reporting that VIP guests and premium players accounted for a greater share of gaming revenue than ever before. Industry analysts note that in the years following the pandemic, the average spend per visitor rose sharply, but the pool of big spenders grew smaller and more concentrated. This shift created both opportunity and risk. A handful of patrons could make or break a quarter, but their funds and their backgrounds demanded closer scrutiny. At the same time, federal policymakers moved to tighten financial transparency across the economy. The Corporate Transparency Act, enacted in 2021 and rolled out in phases through 2024, requires companies, including those with casino ownership stakes, to disclose their true beneficial owners to FinCEN. This law aims to peel back layers of shell companies and trusts that have long obscured the flow of money into and out of major enterprises. For casino operators, especially those structured as real estate investment trusts or with complex international partnerships, the new rules mean that regulators can now trace capital back to its source with far more precision. FinCEN's parallel advisories on politically exposed persons, foreign corruption, and high-risk jurisdictions have placed additional pressure on casinos to know exactly who their patrons are and where their money comes from. The timing of these regulatory changes is no accident. as global headlines spotlighted illicit funds moving through banks, real estate, and luxury assets. U.S. authorities identified casinos as a key vulnerability. Congressional hearings and Treasury reports have singled out gaming venues for their role in large anonymous cash transactions and their appeal to foreign capital seeking discretion. The result is a policy environment where enforcement is not only encouraged but expected. FinCEN's own directors have warned that the casino sector cannot be treated as an exception to the rules that govern banks and other financial institutions. For Las Vegas, these outside pressures land at a moment of economic uncertainty. Convention business, a mainstay of Strip revenue, has yet to fully recover. International travel remains uneven, and operators face rising threats from labor to cybersecurity, on top of regulatory obligations. The temptation to chase VIP dollars, even when red flags appear, grows stronger as margins tighten elsewhere. Yet every large cash buy-in, every international wire, and every new high-roller relationship now falls under a microscope, sharpened by both state and federal mandates. Analysts and policy experts describe this convergence as the new normal. The days of informal warnings and quiet settlements are giving way to a regime where enforcement actions are public, penalties are substantial, and compliance is a boardroom priority. The Corporate Transparency Act's beneficial ownership rules, combined with FinCEN's expanded reporting expectations, have made it nearly impossible for operators to plead ignorance when suspicious funds cross their thresholds. In this climate, even a single lapse, a missed source of funds check, or a poorly documented VIP relationship can trigger investigations that ripple through licensing, reputation, and the bottom line. The macro forces reshaping Las Vegas casinos are not temporary shocks. They are structural, rooted in global efforts to stem financial crime and in the economic realities of a city still rebuilding from the pandemic's disruption. For operators, the choice is not whether to adapt, but how quickly and at what cost. The next wave of enforcement is not a question of if, but when. Casino procedures on the Strip now reflect a new reality. High-value guests used to breeze through onboarding, but today, every VIP faces a battery of questions and document requests before a marker is approved. What once took minutes now stretches into hours, as compliance teams double-check identification, source of funds paperwork, and international wire details. At the cage, cashiers verify every large buy-in against daily transaction logs, slowing down the pace for even the most familiar faces. Hosts and marketing staff are required to submit detailed profiles for each new high roller, including business affiliations and prior play history. Some properties have added a second layer of review for complimentary suites or private jet travel, with compliance officers signing off before any offer goes out. Staff training sessions now run monthly, not quarterly, and every frontline employee must log their diligent steps for audit. These changes are visible not just in policy, but in the daily routines of everyone from hosts to cage cashiers. Bond rating agencies have begun to factor regulatory investigations and anti-money laundering penalties into their outlooks for major casino operators. After Resorts World Las Vegas received its $10.5 million fine in early 2025, analysts flagged the potential for higher borrowing costs if compliance failures persist. The risk isn't limited to a single property. Repeated violations can jeopardize a company's ability to refinance debt or expand operations, especially when license renewals are under review. In one recent case, an operator's cost of capital increased following a high-profile enforcement action, with lenders citing reputational risk as a concern. Public disciplinary hearings and multi-million-dollar fines now appear in analyst notes and investor calls, raising questions about long-term brand value and market access. For companies whose licenses are their most valuable asset, even the perception of weak controls can threaten credit ratings, trigger shareholder lawsuits, and limit future growth. 3 questions now define the future for Las Vegas casinos. Will operators make real, lasting changes to their compliance culture, investing in stronger monitoring, empowering anti-money laundering teams, and rethinking their approach to high-value guests? Or will the cycle of surface fixes continue until the next scandal? As enforcement becomes more visible and procedures more demanding, how will these changes reshape the experience for both VIP guests and everyday visitors? Faster onboarding and no questions asked perks once drew guests from around the world, but the new reality is slower, more cautious, and far less anonymous. And as economic pressure lingers, with casinos relying on a shrinking pool of big spenders, is another wave of investigations and penalties inevitable. These questions now hang over the Strip, shaping how operators, regulators, and players all navigate what comes next. Right now, Las Vegas casinos face more public scrutiny and higher penalties than ever before, with over $100 million in anti-money laundering fines issued nationally since 2020. As federal oversight tightens and economic pressure grows, every bet placed is weighed against compliance risks. The Strip's future may hinge less on luck and more on transparency. The next move belongs to those willing to adapt, or they risk being left behind.